Ladies and gentlemen, we have seen a very serious escalation of tensions in the Middle East between Iran and Israel over the last 1 week, and this has served to apply brakes on what was turning out to be a dream run in equity markets around the world. But what do these geopolitical upheavals mean for equity markets? Do they mean an end to the dream run that we have been witnessing in equity markets for a while now? Or is this something that is likely to resolve very soon, and post that we are likely to see a resumption in the rally that has been on for a while now? Well, that's exactly what we are going to discuss in this video. Ladies and gentlemen, a very warm welcome to each and every one of you. I want to begin by thanking each and every one of you for the overwhelming show of love and support to my last video, in which I discussed how equity markets are likely to evolve from here now that the Fed has started to cut Fed funds rate. Now, the video that I'm talking about is, of course, this one which I published on 21st of September 2024, and since then this video has already received more than 44,000 views. And more than 1,500 of you have been kind enough to subscribe to my channel after watching this video. So, ladies and gentlemen, a very big thanks to all of you from the bottom of my heart for this overwhelming show of love and support for my work. Now coming to what's happening in equity markets and what is my current market outlook in the light of outbreak of conflict in the Middle East between Iran and Israel. Equity markets indeed have had a very turbulent week. The Nifty first hit a new all-time high of about 26,200 points on Thursday of last week, that's 26th of September 2024. It's been about 1 week since then, and during this time we have had the outbreak of conflict in the Middle East, and that has dragged the Nifty down by 1,200 points. That's a correction of almost 5%. And the sharp pullback in the Nifty has meant that all my social media handles have been inundated by messages from worried investors and clients who all want to know what is my market outlook at this stage in the light of outbreak of hostilities in the Middle East. Is this the beginning of the market crash that I've been talking about for a while now? Or is this something that is likely to resolve within a short period of time, post which we are likely to see a resumption in the equity market rally? But before I talk about my current market outlook in the light of outbreak of conflict in the Middle East, I want to first set the context and do a very quick recap of the market outlook that I had presented in my last video as recently as 2 weeks back. Now, those of you who have followed me on my YouTube channel would know that it's been my long-held view that we'll first see a marked acceleration in the equity market rally once the Fed starts to cut Fed funds rate, and that this rally will continue as the Fed continues with its rate cut cycle. But at the same time, I've also reiterated many times in my previous videos that I do believe that the US economy will slip into a recession sooner rather than later. And as and when that happens, that will be the point in time when the equity market rally will also start to fizzle out and eventually will pave the way for a sizable market correction to play out. But before we get any such sizable market correction, once again to repeat, we'll first see a remarkable acceleration in the equity market rally. In fact, those of you who have seen my last video would know that I have also laid out 3 conditions that have to be fully met before this equity market rally can come to an end and can pave the way for a sizable market correction. And what are these conditions? The 3 conditions are these. Basically, I had proposed these 3 conditions in this earlier video of mine that I had published in April of 2024. In this video, I had basically proposed that a material market correction can materialize only after all these 3 conditions have been fully met. Right now, only one of these 3 conditions, Fed starting to cut Fed funds rate, this is the only condition that has been met. The remaining 2 conditions continue to remain not satisfied. And that's why, ladies and gentlemen, I reiterated in my last video that the conditions necessary for a sizable market correction to materialize are not yet in place. And hence, I continue to remain fully invested in equities in my personal investment portfolio. Now, is this a view that deserves to be reconsidered in the light of outbreak of conflict in the Middle East over the last 1 week? Ladies and gentlemen, those of you who have followed me for a while on my YouTube channel would probably know that my market outlook is something that doesn't necessarily change very frequently, just based on news flows. And that's why, dear friends, at this stage, I do not feel compelled to revisit my market outlook despite the outbreak of violence in the Middle East. And I'll tell you why the outbreak of violence in the Middle East, at least for now, is not really a very big deal, not at least from an equity market standpoint. Now, if you have to gauge the likely impact of outbreak of conflict in the Middle East, then the event that serves as the closest parallel was the Russian invasion of Ukraine that started on 24th of February 2022. And as soon as the Russian invasion of Ukraine started back in February of 2022, the Nifty reacted in a very, very similar fashion as it is reacting today. In a single session on 24th of February 2022, the Nifty corrected by more than 800 points. That was a correction of almost 5% on that day. What is the scale of correction that we have got so far this time round in the immediate aftermath of the outbreak of violence in the Middle East? Almost the same, 5%. And that's why, ladies and gentlemen, it's important to study and draw lessons from what happened during the Russia-Ukraine conflict if we have to objectively assess the potential impact of the ongoing conflict in the Middle East. Because these are two conflicts which are similar to each other in more ways than one. Begin with, both these conflicts have had a huge bearing on global energy prices. In case of the Russia-Ukraine conflict, one of the parties involved, of course, is Russia, which is one of the largest energy exporters of the world. In fact, when the conflict broke out back in 2022, Russia was the single largest supplier of gas to Western Europe. And disruptions in energy supplies because of the outbreak of the Russia-Ukraine conflict led to humongous price increase in energy prices across Europe. And we can see a similar trend playing out during the course of the ongoing conflict in the Middle East. Because Iran has an outsized impact on global energy prices. Not because Iran is a major energy exporter, it's not. That's because there are American sanctions in place on Iranian oil exports. Despite that, Iran has an outsized impact on global energy prices because Iran and its proxies in the Middle East, especially the Houthi rebels in Yemen, have the capability and have demonstrated the capability to disrupt the shipping lines through which most of the oil that flows out of the Middle East flows through. That's why we have seen quite sharp increases in energy prices as well over the last 1 week. But what is going to be the cumulative impact of all these on equity markets? Well, for that, it might be useful to go back and check what was the impact on equity markets during the course of the Russia-Ukraine conflict. And in case of the Russia-Ukraine conflict, as I just mentioned a little while back, to begin with, we got a 5% correction in the Nifty on the day the Russian invasion of Ukraine started on 24th of February 2022. But this correction went on all the way till June of 2022, which is when the Nifty finally made a bottom. But by then, the Nifty had corrected cumulatively by more than 10% since the beginning of Russian invasion of Ukraine. And this, according to me, serves as a useful reference when it comes to gauging the likely impact on equity markets because of the ongoing conflict in the Middle East. So are we in for another 10% correction in equity markets? Well, that's entirely possible. And what is also entirely possible is that we could get a larger than expected flare up in the level of conflict in the Middle East, and that in turn causes a larger than expected disruption in energy flows. That could well mean that the scale of equity market correction this time around could be slightly bigger. But I'll be very, very surprised if the cumulative impact on the equity markets because of the ongoing conflict in the Middle East on its own, without any additional adverse geopolitical developments, is more than 10 to 15%. In fact, we should also be open to the possibility that the scale of the equity market correction this time round could well be lesser than the scale of the equity market correction that was witnessed during the course of the Russia-Ukraine conflict. Because the Russia-Ukraine conflict played out in the backdrop of the Fed increasing Fed funds rate, which is inherently adverse for stocks. However, the current crisis in the Middle East is playing out in the backdrop of the Fed, in fact, cutting Fed funds rate, something that by definition is conducive for stocks. Either way, believe me, the dust will settle on this conflict sooner rather than later, as it has in case of every previous conflict in the Middle East. And once that happens, believe you me, it will start to become very, very clear that the factors that typically drive an equity market rally during the course of a rate cut cycle are very much intact. In fact, by the time dust settles on this conflict, will very likely be on the other side of the US elections. And equity markets will have the added advantage of having a clearer visibility of the policy objectives of the presumptive winner. And a combination of clarity on election outcome in the US and some kind of a resolution of the crisis in the Middle East, I believe, will once again present to us a raging bull market environment. And at this stage, I believe that we'll be back there by no later than Christmas of this year. And once we are there, believe me, once again, I'll be the only odd one out who will be pointing out to everybody that this rally will not last forever and that this rally will start to fizzle out once the US economy slips into a recession. And to that extent, I have very little doubt that this equity market rally is now in its very last leg. It's just that I don't think that this equity market rally is coming to an end right now because of the conflict in the Middle East. Instead, I believe that this equity market rally will eventually come to an end a little while later because of the onset of a recession in the US. Now, a lot of people get very upset whenever I talk about the possibility of a recession in the US and an accompanying crash in equity markets. Some even accuse me of trying to spread fears about a market crash. But my dear friends, believe me, when I talk about the possibility of a market crash in the aftermath of the US economy slipping into a recession, I am not doing so in the spirit of trying to spread fear. Instead, for me, any such market crash is nothing but a once in a cycle opportunity to make some serious money during the course of the upheaval that we are likely to witness in the near future. And that is because I am very, very confident about what is the kind of movie that is going to play out on the other side of the market crash. And what is this movie that I am talking about? This is the same movie that has played out after the last two recessions in the US. During the course of the global financial crisis of 2008, the Nifty went down by 60% between January and October of 2008, and corrections of similar order were witnessed in almost every equity market around the world. And in response to such a large market dislocation, the Fed started its quantitative easing program in 2008, which went on for next 6 years. And during the course of these 6 years, the Fed ended up printing as much as $3.5 trillion. And because of the scale of money printing that was witnessed during the course of these 6 years, Nifty and equity markets around the world were able to make full recovery from the correction that was witnessed during the course of 2008 and were able to get back to the pre-crash highs of January 2008 within a span of just 3 years. This is what happened in 2008. Now fast forward to 2020 when the US economy once again slipped into a recession because of the onset of the COVID pandemic, and once again the same movie repeated all over again. The only difference being that this movie this time round repeated on a much larger scale. So as soon as the US economy slipped into a recession because of the onset of the COVID pandemic, equity markets around the world started to witness very sharp corrections. The Nifty in India corrected by almost 40% between February and March of 2020. And in response to such sharp corrections in equity markets around the world, the Federal Reserve decided to restart its money printing program on 23rd March 2020. The only difference this time round was that the scale of money printing was going to be of a completely different order. Over the next 2 years, the Fed ended up printing almost $5 trillion. In the previous round, in the aftermath of the global financial crisis of 2008, the Fed had printed $3.5 trillion over a 6-year period. In the aftermath of the COVID pandemic, the Fed ended up printing almost 50% more, $5 trillion, and that too in 1/3 the time in just 2 years. And because of the sheer scale of money printing in 2020, equity markets were able to make full recovery this time round, not in 3, not in 2, not even in 1, but within a matter of few months after the money printing program started. In 2020, for the first time in the history of equity markets, almost every leading equity market in the world was able to get back to its pre-crash level within the same calendar year. Just imagine, back in 2008, it took equity markets around the world almost 3 years to make full recovery back to the level of pre-crash levels. In 2020, most equity markets around the world were able to make full recovery from the crash within the same calendar year. And I have no doubts that it's the same movie that is going to repeat once again once the US economy slips into a recession the next time round. In fact, I strongly believe that the Fed could well end up printing more than what it printed in the last 2 recessions put together. I won't be surprised if the Fed, in fact, ends up printing anywhere between $8 to $9 trillion during the course of the next recession. And that in turn will ensure 2 things. First, equity markets around the world will be able to make full recovery in record time. And secondly, equity markets will continue to make new all-time highs after they have made full recovery. And that's why, ladies and gentlemen, the recession in the US that I expect to set in a not too distant future, and the equity market correction that is likely to accompany the recession, is not something that we should fear. In fact, this is something that we should absolutely look forward to. Because if we are able to optimally play the upheaval in equity markets that lies ahead of us, which basically means that if we can plan our exit from equity markets before the onset of a market crash that is likely to accompany the onset of a recession in the US, and let's say we are able to do that even with a 70 to 80% accuracy. And once again, we are able to plan our re-entry into equity markets closer towards the bottom once this market crash has fully played out. Once again, let's say with a 70 to 80% accuracy. I'm not even suggesting that anybody would be able to catch the exact peak and bottom before and after the crash, then undoubtedly there is a serious amount of money to be made during the course of the upheaval that lies ahead. And that's why, ladies and gentlemen, I not only discussed my market outlook on how I expect equity markets to evolve from here in my last video, I also discussed immediately preceding my last video our proprietary AlphaSIP strategy that we offer to our paying clients, and I did so over a 4-part series. And the reason I discussed the AlphaSIP strategy is because this is a strategy which has been designed to help investors navigate exactly the kind of market upheavals that I believe lie ahead of us at this stage. This is the 4-part series during the course of which I described the details of our proprietary AlphaSIP strategy, which can potentially help investors time their exit from equity markets close to a market peak, and once again potentially time their re-entry into equity markets close to a market bottom after a crash has fully played out, and in the process capture the upside of equity markets during times when markets are witness to very strong bull runs, but more importantly also enjoy a level of downside protection that is at least comparable, if not better than that offered by bank fixed deposits during times when markets are witness to sharp drawdowns. One thing that I was completely not prepared for, as I was explaining the details of our AlphaSIP strategy and as I was explaining the details of the market upheaval that I believe lie ahead of us as part of this video that I published last week, is the sheer volume of inquiries that started to pour in on our email address and on our WhatsApp number from those of you who were interested in the AlphaSIP strategy. And the reason we were not prepared for this is because as an organization, Metacaps.ai is a very, very small entity. Between me and those who help me with respect to technology, research, operations, and sales, there are less than 10 people in the team. And that's why, in terms of our business model, we have always been very, very clear that we cannot really be a classical B2C wealth management platform that is equipped to handle a very large number of clients. And that's why traditionally our strategy has been to work with only a very limited number of high net worth clients. They're very, very limited in numbers, but in terms of the amounts that they invest through us, these amounts tend to be very, very large. And that's why we were completely overwhelmed when we were faced with such a large volume of inquiries from those of you who expressed their interest to invest through us in our AlphaSIP strategy. So much so that those of you who would have visited our website in recent times would have noticed that we have had to put up this client notice informing potential clients that we do not really have the bandwidth to onboard any more new clients at this point in time, and that we'll be reopening the onboarding window only after we have added more capacity to our sales team. And despite this client notice, what has been quite humbling for us is that inquiries have continued to pour in. And while my team has tried their best to attend to as many inquiries as possible, the sad reality is that a very large number of inquiries continue to remain unattended. Ladies and gentlemen, at this stage, I wish to apologize to those who had dropped in their inquiries, but we were not able to revert back to them. But my dear friends, I'm very, very happy to share with you that we have worked on increasing the capacity of our sales team, and as a result, we will be reopening the onboarding window for new clients for a limited period. But my dear friends, we are very, very cognizant of the fact that despite the enhancement in the capacity of our sales team, we do not still have the bandwidth to onboard a very, very large number of clients. And that's why for now we have decided that we'll be onboarding only 25 new clients, and then we'll be assessing what is the kind of effort and bandwidth that goes towards servicing these clients without really going down on our customer service standards. And only after we have onboarded these 25 clients and we have completed our internal assessment of what kind of effort and bandwidth that goes towards servicing these clients, will we have a more accurate idea of how many clients can we onboard on an ongoing basis every month going forward given our current capacity. And that's when we'll probably reopen our onboarding window for second round of client onboarding. But for now, if you're interested in investing in our AlphaSIP strategy and joining this first batch of 25 retail clients that we are about to onboard for now, then this is what you need to do. First step is to go through the 4-part series in which I have explained what the AlphaSIP strategy is all about. This is the 4-part series in which I tried to explain what the AlphaSIP strategy is about, what is the investment problem that we are trying to solve for our clients, and historically, what is the kind of outcome that the AlphaSIP strategy has been able to produce for our clients in the past. Now, I have packed more than 2.5 hours worth of content between these 4 videos. And if that sounds like a lot to go through, at least go through this one video. the part 4 of this series. Once you have gone through the 4-part series, or at least part 4 of the 4-part series, you can go to our website and fill up the registration form required for signing up for the AlphaSIP strategy. Mind you, at this point in time, we have not yet started accepting registrations for the AlphaSIP strategy because we are still putting in place the systems that we believe are going to be necessary for processing the volume of applications that we believe are likely to flow in once we start accepting registration. But I believe we will be ready by next week, and once we are, I will come up with a dedicated video to inform you about the same. But if you're interested in the AlphaSIP strategy, there are a couple of points that I want you to keep in mind before you register for investing through the AlphaSIP strategy. The first point that I want you to keep in mind is that all investments done through the AlphaSIP strategy will be in zero allocation charge ULIP schemes of Bajaj Allianz Life Insurance Company. What are zero allocation charge ULIPs? Well, for that, you'll have to go back and watch part 4 of the 4-part series. The next point I want you to keep in mind if you're interested in the AlphaSIP strategy is that the minimum investment amount required for investing in the AlphaSIP strategy is 5 lakh rupees per year. And you have to invest this amount every year for a period of 5 years. So it's a commitment to invest 5 lakhs into 5 years. That's 25 lakh rupees for over a 5-year period. This is a minimum investment amount that has been set not by us but by Bajaj Allianz. And this is something that they have revised upwards very, very recently. Until recently, the minimum amount required for investing in zero allocation charge ULIPs was 2.5 lakh rupees per year. From 1st September onwards, Bajaj Allianz has revised this threshold upwards to 5 lakh rupees per annum. Alternatively, you can do a one-time lump sum investment of 21 lakh rupees. We'll first park this 21 lakh rupee corpus in a set of mutual funds, and we'll rebalance this mutual fund corpus between a set of equity funds and debt funds using exactly the same logic that we use for rebalancing our ULIP portfolios. And we'll use this 21 lakh rupee corpus to fund a ULIP investment plan of 5 lakh rupees per year, and we will do this investment over a 5-year period. So at the end of 5 years, your entire investment amount will be transferred from mutual funds into ULIPs. The next point I want you to keep in mind is that these investments are subject to a 5-year lock-in, which means that you will not be able to stop your investments and you will not be able to take your investments out in the first 5 years. These investments will be available for redemptions only at the end of 5 years. This is a restriction which once again has been imposed by Bajaj Allianz, not by us. But to be honest, even if this restriction were not there from the side of Bajaj Allianz, we would not have accepted your investments if you are not okay with this lock-in of 5 years, because this 5-year lock-in is the only way for us to enforce a discipline on you to ensure that you stick around with the investment plan for a period of at least 5 years. And why is the minimum investment period of 5 years so important? Well, that's because if you go through the 4-part series, you will realize that 5 years is the bare minimum that we need in order to deliver outcomes to our investors in line with the historical performance of the AlphaSIP strategy. And the final point that I want you to keep in mind if you're interested in the AlphaSIP strategy is that we will have a nominal fees that we will impose if you want to register for the AlphaSIP strategy. Now, this is not really a fees per se, because whatever amount we are going to charge you at the time of registering for the AlphaSIP strategy, we will refund this entire amount to you after you have completed your investment in the AlphaSIP strategy. But nevertheless, we believe a refundable charge like this is necessary at the time of registration, because we have only 25 slots available for now for onboarding our first set of retail clients. And for this round, we want only very serious investors to register. And finally, I wish to appeal to all my viewers that you should not construe anything that I have said in this video as any kind of solicitation for investing in the AlphaSIP strategy. Because it's not as if that I'm trying to sell anything to anyone through this video. In fact, if you go through the 4-part series in which I have described the AlphaSIP strategy, and I have packed more than 2.5 hours worth of content between these 4 videos, you will realize that I have given away the name of the funds that I use as part of the AlphaSIP strategy. I've given away almost the entire logic that I use as part of the AlphaSIP strategy, and that anybody who cares to take time to go through all these 4 videos end to end would have sufficient knowledge to manage his or her investment portfolio by himself without having to buy anything from me. Ladies and gentlemen, this brings me to the end of this video. I would love to hear your thoughts both for and against the investment thesis that I presented during the course of this video to argue my case that I do not believe that the ongoing conflict in the Middle East is going to lead to a very, very large market correction at this point in time. I do not expect everyone to agree with my investment thesis. In fact, I could be horribly wrong with the investment thesis that I presented during the course of this video. I've been wrong many, many times in the past, and I'm going to be wrong many, many times in the future as well. But the good thing is that we'll know in a few weeks' time whether I was right or wrong. And for those who are interested in signing up for the AlphaSIP strategy, please do watch out for my next video, which I will release once we are ready to accept registrations for the AlphaSIP strategy. Ladies and gentlemen, I hope you liked the insights that I shared during the course of this video. If you did, then please do like and share this video, and please do consider subscribing to my channel. Thank you very much.